So SG&A done, then you have operating income. After operating income, you have an interest tax. You have an interest expense. So leave interest expense for now. That we will look in later. And there can be 2-3 ways of forecasting interest expense. So first thing that you should look at when you are forecasting interest expenses is its size. That how much is it impacting the overall company. So if you look into its size, it is very small. Second is you look at the trend. So if you look at the trend, it is decreasing. Means that that company has taken is very low probably. If a company has large amount of debt, then interest rate is high. If a company has lower amount of debt, then interest is low. Secondly, how do you forecast it? So if it is very insignificant or immaterial, then you can just take it at current levels or based on the historic trend, and then you can make adjustment in balance sheet based on that. Otherwise, how do you do this? Otherwise, you will find out the interest rate from company's annual reports, that what is the interest rate that it is paying on bank accounts, on OD or on loan, and then you will multiply it with the forecasted loan or forecasted debt when you have forecasted the balance sheet. So this decision will be decided after forecasting the balance sheet. Then you will decide whether is it significant enough or immaterial or material to be included. Interest, so you should look at the global level, because this is generally being taken at global level. So if financing is required in a country, generally what they do is that they would borrow at a lower rate, because due to their size, they are able to borrow at a lower rate through head office, and then they will transfer it.
What about if the company plans for an expansion?
So when you forecast balance sheet, in that balance sheet you will forecast capex. Sorry, not in balance sheet. When you are forecasting balance sheet, you will forecast assets. Those assets would be forecasted based on capex, right? So when you forecast capex, when you forecast asset, and when you forecast balance sheet, after that you will be forecasting cash flow. So you would know that whether you have enough money to finance that capex or not. So if you have enough money to finance that capex, and you know that company will be funding capex through its own reserves and its own operating cash flow, then you do not need to make any changes to loan value. But if you then get to know that company does not have enough operating cash flow, company does not have enough reserve, and it will be borrowing money for this capex, then you need to build it in loan. And when loan increases or loan goes up, then your interest will also go up. So you will link this interest expense to that particular loan. So you will multiply, you will get an assumption for rate, and then you will multiply with loan. So once you have made the balance sheet, then you decide whether is it material enough, or there is a requirement for future loan due to which you should forecast it all, or is it fine this way that you just stretch it, or you just take the average. So after you make the balance sheet, you are in a better position to decide how to forecast this. If there is a need for additional capital, additional loan, or loan is a big amount, then you need to forecast the expense, because then that will substantially change in future. Otherwise, in base case, it wouldn't substantially change. Then interest income, again income on your bank account. Generally, any company is maintaining approximately similar levels of cash throughout the year. That helps meet them liquidity requirement while not impacting on their return. So that's why it will again generally be a very small component, because most of it wouldn't be in the form of assets. Company would either pay dividend, or would invest into expansion, or would buy a plant for expansion, rather than keeping a cash. Even then, if it has cash for no use, then it will pay off a dividend. So as cash is low compared to total amount of assets, its interest income is also very low or immaterial. Again, you will decide it based on the cash needs for future. Maybe in future company needs to keep more cash. So when you project balance sheet, if a need comes in and you think that interest income needs to be forecasted separately, then you will forecast it from based on that. Otherwise, you can just stretch it, or you can just take average. Other non-operating income or net income, or you can also take it as these as percentage of sales, but this again will be very insignificant. Amount is very insignificant.